Welcome back to EDS, and in this video I'm going to show you how to find hidden trading opportunities, and I'm also going to give you my #1 best strategy that you can use to exploit these opportunities. And this strategy is going to give you a very high return on your capital, and it's also going to give you very consistent returns. So the first thing that you want to do is pull up a watch list of futures that have options available to trade on them. We are going to be writing options contracts, which allows us to control our probability of success on entry, and we are going to be writing those contracts on futures because futures uses span margin, and that's going to allow us to be capital efficient, and that's what's going to give us our high returns. So once you've got your watch list open, if your broker doesn't display this watch list natively, then just copy down these ticker symbols and make your own custom watch list. You then want to have IV rank up as one of your metrics on the watch list, and you want to order everything from high to low IV rank. This is because we want to sell when volatility is high, or we want to write the contracts when volatility is high. The reason why is because option prices are affected by volatility. When volatility is high, option prices are high, and when we are writing contracts, we are short those contracts. So we want to sell high, buy low. Volatility is contracting about 80% of the time in the market, and it's also mean reverting. That's one of the reasons why this strategy works so well. So once you've got everything open, you only want to look at things to trade that have an IV rank of at least 30. So our cutoff point on this watch list today is going to be at the Lean Hogs futures, which has an IV rank of 32.6. Anything with an IV rank of over 30 is considered high. Over 50 is considered very high. And I like to be around the mid to high range. If you have a smaller account, you probably want to stick to things like currencies, bonds, soybeans, etc. If you have a larger account, by all means, trade whatever you like. Whatever it is that you choose, make sure that it fits well in your portfolio. Don't be too concentrated in any one sector or industry. Keep things nice and diverse. So today we are going to take a look at the British Pound futures. It has an IV rank of 64.4 and an IV percentage of 9. So once you've selected your underlying, you then want to pull up a list of option expiration dates for that underlying. As you can see here on the left, we have the expiration dates, and next to it we have the corresponding futures contract. You don't need to worry too much about which futures contract it is that you're going to trade, because your broker will automatically line things up like this, whether it displays it for you up front or whether it just does it on the back end. Your broker will take care of this, and the expiration date that you want to pick needs to be between 30 and 60 days out in time. And so we have the 51 day to expiration contract here, which is April 4th. So we're gonna expiration date. So we're gonna open that up, and now we are presented with the options chain. So very quickly, I'm sure you guys already know what we're looking at, but we have calls on the left, puts on the right. This horizontal orange bar shows us where the price of the underlying is with respect to the strikes that are going down the middle here. We have our 1 and 2 standard deviation levels shown by these dotted blue lines. We have our IV percentage in the top right, as well as the expected move in parentheses, and the expected move is also visually represented with this orange vertical bar. So once you've got everything set up like this, what you want to then do is simply sell one call and one put. Very, very simple. This is a very powerful strategy. Now the key is knowing where to sell them. So when you are writing contracts, or when you're short an options contract, you want price to stay away from those contracts. You want those contracts to be out of the money. So if we know what the expected move is, in order to get a high probability of success, we simply just write contracts outside of the expected move. The further out you go, the higher your probability of success. However, the lower your return on capital will be, because the less premium you will collect. So a sweet spot, in my opinion, is to be around the 1 standard deviation level, and that will typically line up with a 15 to 20 delta. So if we start on the call side, we have a 14 delta here, and we're going to sell the 128 strike, and we have a 14 delta on the put side as well at the 1.195 strike, and we're going to sell that. And what you'll notice is both contracts are outside of the expected move. They're around the 1 standard deviation level, and they're about between 15 and 20 deltas. So what we want to happen is for price to stay within this range that we have now created for ourselves at the point of expiration, which is in 51 days time. And the chance of making money on this trade, if we look in the bottom left corner, is 74%. That's denoted by our POP, which is probability of profit, and that's our probability of making at least 1 penny on this trade. So anything over 50% is considered a high probability trade. So we got 74% here. And that's if we hold till expiration. But we don't have to hold till expiration. We can get out at, say, 50% of max profit. And ordinarily for equities, our P50 number here would be displayed, but for futures it isn't. But your P50 is basically going to be about 10 to 15% higher than your POP. So your P50 in this case would be around 85 to 90%. So we're looking at between 74 and 90% probability of success here, depending on how long you want to hold it. You can hold it for even less time, save 25% of max profit, and your probability of success will be well over 90%. So extremely high probabilities here. And if we were to get filled at this mid price of 0.0056, once that's been multiplied out by the contract multiplier, you don't need to worry about that because your broker will do it for you. As you can see here, our max profit on this trade would be $350, and that would get added to our cash balance automatically by our broker as soon as this order gets filled. And our broker is going to require just over 1.2k in buying power to open this position. So as you can see here, we are getting a nice return on capital in 51 days time, very high probabilities of success. And we also have this theta number, which is $10.57, so basically $10.58. And what that's telling us is that assuming all stays equal, that's what our daily P&L will be, $10.5758. And as we get closer to expiration, assuming all else stays equal, this number will get more and more aggressive by an exponential factor. Now, if we want to increase our return on capital, we can go to, say, the 21 delta on either side, or 21 on the call side and the 19 on the put side. And what you'll notice now is that our contracts are closer together, but if you look at our max profit here, it's 550. So we've increased our max profit by just under 50%, and our buying power requirement hasn't really increased too much. It's still only about 1.3k. So now our return on capital has increased. Our POP has suffered slightly. That's the trade-off here. The higher your return on capital, the lower your probability of success. In environments where the edge is really in our favor, i.e. IV rank is super high, you can go to, say, the 30 delta on either side. And now we will be collecting $900 up front, and our broker is going to require 1.4k in buying power to open this position. So we're getting very, very high returns on our capital, and our probabilities of success are still very high. And this is before taking into account that implied volatility is generally overstated compared to actual volatility. So in reality, your probabilities of success will be even higher than this. And this also doesn't take into account any adjustments or trade management that you do once the trade is live, and that will also increase your probability of success as well. So all in all, this is literally the only strategy that I use. This is called a strangle. You can do things like iron condors, but your probability of success will suffer. I highly recommend strangles if you can, if your account can handle it. You do need to keep your buying power requirements in check, and in order to do that, we've created a free position sizing template for everyone to use. The link is in the description. And the way that the position sizing template works is that you enter in the size of your portfolio at the top. So say if you have a $10,000 account, below you can then enter in the current VIX level. So say if it's 12.1, and then everything will be automatically calculated for you. You simply just need to use this information to form the backbone of your portfolio, and you'll be absolutely fine over the long term. If you do want to learn in more detail about what we do and how we do it, click on EDS Premium. Again, the link will be in the description, and get yourself signed up. Inside, you will have access to our portfolio that will allow you to see the positions that we place, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals, and there's a 100% money back guarantee. So once you have studied the full course, followed some of our trades, if after 6 months you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's $9.99 a month to join right now. The price will be increasing, and that's not a sales tactic. So for anyone that's been around for a little while, you'll know that the price originally was at £1 a month. Once the first wave of members joined, then we increased the price to $9.99. Now we're on the second wave. Once the second wave is full, we will be increasing the price again. So you are rewarded for getting in early, and the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. Once you have learned the skill, no one can take it away from you. You can keep it for the rest of your life, and we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but in under a year you should be good to go. So with that being said, I will see you guys on the inside.